While financial markets like stocks are rolling back over after the one day of near historic euphoria, we're getting signals from deep inside the monetary system that are deeply negative. One segment that we follow very closely all the time is sending some warnings about some pretty bad scenarios. In fact, these spreads plunged, and I mean plunged, to record lows this week. And not just record lows, but record lows that obliterate the previous record lows. What that means is a really high chance of deflationary conditions. And wouldn't you know it, just this morning, the BLS reported an unexpected and outright decline in U.S. consumer prices for the month of March that no one saw coming except maybe this market segment. And while gasoline was a big part of the drop in consumer prices, it wasn't the only factor. The deflationary impulse last month was indeed widespread. And this is what's driving the financial volatility in everything from stocks to commodities. It really isn't about tariffs and trade wars. It's the sharp loss of momentum that's been getting more and more visible the past few months leading up to them. And we've heard it from everywhere. So here's yet another piece of confirmation right in the heart of the consumer economy. It's like last year's CPI, as I mentioned back then, a marching band full of red flags. Negative consumer prices signify a serious drop in demand that financial markets are worried will be more than just for March, that the consequences are going to be felt beyond the short run. That's the selling. That's the liquidations. That's what our spreads are also saying, but taking it a step farther. Having already warned the system was fragile, therefore susceptible to something like this week's plunge to deep record lows goes way beyond today and tomorrow, out to next year and further down the road. And we're not talking about inflation. It's not a soft landing. In their purest interpretation, these warnings say interest rates are going to tank and then stay there. That seemed ridiculous to most people 2 and 3 years ago when these warnings first showed up. It only seemed a little less far-fetched last year when the warnings grew stronger. How about now, though? And these are dependable signals that we've been relying on for many, many years. I'm talking about interest rate swaps and interest rate swap spreads. What are they? They may be complicated, but they're relatively easy to understand from a top-level perspective. And we'll give you a quick primer here for those who aren't familiar with interest rate swaps and spreads. And by the way, if you aren't familiar and you want to get familiar, I did a 4-part video series at Eurodollar University for Eurodollar University members. What are interest rate swaps? Why are they so important? And what do those spreads mean? Honestly, interest rate swaps are probably the most critical financial derivative instruments that are out there. The market for them is incomprehensibly massive. There isn't a part of the financial world that they don't touch. And there are money dealers in between almost every single swap trade, which means dealers have information on conditions and their own perceptions of what's really happening across not just the financial world, but also the commercial world, because interest rate swap counterparties include some of the biggest companies from all over the planet. So you've got banks, you've got financial participants, and you've got real world businesses. So it's swaps and swap spreads tell us what dealers are thinking, what their customers are thinking about broader financial and commercial conditions all over the place. So swap spreads and rates are probably even more important than the yield curve, and I would argue that they are. So everyone is missing out on this information because, as I said yesterday, the fealty to the Fed. The information that we get from interest rate swap spreads and changes in them often don't look good on the Federal Reserve. Therefore, we're not allowed to talk about these either, just like we're not allowed to talk about what's really behind the basis trade, as I went over in yesterday's video. But an interest rate swap, like I said, it's simply an exchange of cash flows, fixed for floating, but we really don't need to know much about that either. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with monetary metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. But the key here is the spread. And by interest rate swap spread, what I mean is the fixed rate from the interest rate swap compared to the same maturity nominal U.S. Treasury yield. That spread gives us critical information about the thinking, as I said, all across the financial system, the real world, the real economy as well, from the perspective of deep inside the monetary system, deep inside the black hole. It tells us what dealers are thinking as well as what they're seeing and what information they're getting. So we need to pay attention to them. What you need to know is that a negative spread already is bad. That's where the fixed rate from the interest rate swap is less than the same maturity U.S. Treasury yield. So that means counterparties who are willing to take a fixed rate are actually accepting less of a return than they can get on the U.S. Treasury yield. We don't need to know why that's the case here. If you're interested, check out Eurodollar University's basics videos. We'll get into all those details. But a negative spread is bad, and a spread that goes further negative is also a negative signal, because what that means from a very top level perspective is that more people are hedging for lower and lower rates, and fewer people are willing to take the other side of that, hedging for higher rates. As in the last couple of years, where swap spreads have been going negative while everyone has said higher for longer, swap spreads said the marketplace doesn't believe in higher for longer. It's hedging more and more for rates to go down and stay there. That's the thing about longer dated interest rate swap spreads and interest rate swap contracts that we focus on, like the 10 and 30 year maturities. It's not just interest rates are going to go down, but how long are they going to stay down? When you get into longer dated contracts, the more negative those spreads, the more the market perceives that rates are going to go down and stay there. And we also have, like I said, there's information on what's happening in money dealers. Money dealers, if their balance sheets are impaired, if they're seeing or experiencing deflationary conditions, if they don't like the collateral that's been posted to them, all sorts of the deep fundamental monetary considerations that we want to know about, all of it contained in the interest rate swap market and therefore swap spreads. Over the last couple of years, just go back to 2022, we've seen more and more negatives at all maturities for these swap spreads. During the UK gilt crisis, it wasn't really about the UK, nor was it about gilts. From the swap market perspective, it was picking up the conditions in the monetary system as well as the real economy that were going to become the forgot how to grow economy. Not only was it picking up on the forgot how to grow transition, also the longer run consequences from it, which we have been living with. And those consequences have meant lower interest rates, not higher interest rates. So what everybody was hedging in the swap market and the perception from money dealers has actually happened, even though in 2022, in 2023, the idea of lower interest rates seemed preposterous to everybody who was fixated on the inflation scenario, and central bankers that fed it with their idea of potentially 1970s style out of control inflation. The swap market told you from the very beginning that was never a good possibility to begin with. So while everyone was shouting higher for longer, the most important market that we have was saying it probably wasn't going to happen. And then as swap spreads became even more negative in the wake of the 2023 banking crisis for what should be obvious reasons, we got more negative from the summer of 2023. That was the swap market saying, forget higher for longer. The consequences over the long run were going to lead to conditions that would lead interest rates to go down and stay there. And then the swap spreads got even more negative last summer. And all the fireworks that happened afterward were consistent with that. And so while everybody was screaming about higher for longer last year, the market was saying, no, interest rates are going to go lower. And so here we are this year, and the pathway for the world to get there seems to be the most likely option. That was the market realizing the race to the bottom among central bankers, but also in the marketplace had already begun. And more importantly, that it wasn't going to stop. And the reason it wasn't going to stop is because the monetary system, the financial system, and the real economy was not strong and resilient. It was not heading for a soft landing. It was instead fragile. That's what the markets were really warning about, that the entire system was fragile. That's what the forgot how to grow economy was. A fragile system that would be susceptible to the types of developments and outcomes and results that would lead to rates going down and staying there, which is where we are today, where we see more and more conditions that are consistent with those very ideas. But here in 2025, we've got a couple more warnings from the swap market, and some of them are even counterintuitive given what I just told you. We've seen volatility break out in especially the longer dated spreads late January and into February. In fact, we saw long-term swap spreads absolutely soar, which means decompress, become less negative. And while at first it may sound like a good thing, a reversal from deeply negative spreads, this was sort of like when you see a supply squeeze in commodities. It's not going to last. In fact, this is a sign of deep trouble brewing in the swap market, even if it's breaking out in what looks to be a more positive way. That was a sign that the system was increasingly fragile. And we've seen this before where swap spreads acted really volatile like this. In fact, the last time was March of 2020. In March of 2020, the first couple of weeks of that month, as the crisis developed then, swap spreads plunged, then soared, then fell back again. Massive amounts of volatility. We saw the same type of volatility, especially in the 10-year spread, in March of 2023 during the banking crisis then. The 10-year spread absolutely soared while Silicon Valley Bank was failing and Credit Suisse was going down itself. So this volatility in spreads like this, that's a signal of disorder deep down in the monetary system, even if it's the case where spreads are reversing from the deep negatives that they had been moving toward before then. So even though spreads were soaring, that was not a good sign. It was a sign that the market was becoming increasingly fragile. The sign the system was becoming increasingly fragile. And by system, I mean not just the financial system, but also the real economy beside it. And that's exactly what we saw just over the last couple months. As I said, swap spreads soared at the early part of February, which is not a good sign. And then they began to fall back throughout February into March. By the time we get to Tuesday this week, the 10-year swap spread had plunged all the way to minus 58 basis points. And it retraced to minus 47 basis point yesterday, but that's still a hugely negative sign. That deep negative of swap spread means everybody is hedging for rates to go down a lot, and to stay there. And more than that, they're increasingly confident those scenarios are going to play out for interest rates, and therefore the conditions in the monetary system, the real economy, likely deflationary conditions, are indeed going to happen. The 30-year swap spread, that one crashed all the way to minus 93.2 basis points on Tuesday before retracing to minus 81 basis points yesterday. Minus 93 basis points, when you make the equivalent adjustment for SOFR compared to LIBOR, that's the same as the worst parts of March of 2020. So like I said, the market is increasingly confident that rates are going to go down. They're going to go down a lot, and they're going to stay there, and they're going to stay there for a long time. And what are the scenarios that lead the marketplace to those conclusions? Pretty much what we're seeing right now as a start. Some bad scenarios in the marketplace here. It isn't tariffs, it's the economic and financial background before we get to tariffs. Again, it's about fragility. The markets were saying and screaming and warning about a tremendous amount of fragility, and everybody looked the other way because Jay Powell kept saying, strong and resilient, hey, look at GDP, hey, look at payrolls. Never mind the fact that payrolls and GDP overstated the strength and resiliency, and in proper context, the forgot how to grow economy was consistent with everything, including fragility. And then in the wake of all that, this tremendous drop in swap spreads, these record lows that obliterate prior record lows, now we've got the CPI that turns unexpectedly negative for the month of March, the same month where we kept hearing warnings from all over the place from company CEOs, economic data, consumer sentiment, you name it. Tremendous loss of momentum after the artificial high last year, and the fragility the swap market has been warning about all this time. What the BLS reported for the CPI for the month of March was actually a negative, minus 0.05% month over month, which is the first negative in the CPI, first monthly negative, since June of 2024. And while June of 2024 was only fractionally negative, that was, as I said last July, which kicked off the carry trade episode, a marching band full of red flags. In fact, the CPI in March of 2025 is the most negative in any single month since May of 2020. That's how rare this is. The core rate was nearly zero after being way too high to start this year, unleashing all the same claims that this has restarted inflationary pressures. Instead, the core rate comes in at plus 0.06%, very nearly zero. The reason why the CPI was negative overall, the big reason why, gasoline prices plunged, which was no surprise. I've been talking about gasoline prices for the last several months and how they are not tracing out the usual winter pattern. And here's the CPI picking up on that. But it wasn't just gasoline that pushed it negative. Transportation services. We've been talking about airlines. I just talked about them this week. Larry Fink talking about how he said he was having conversations with CEOs, including an airline CEO that said the U.S. is in recession already. So airfares are down. That was a strong negative contribution to the CPI. But even when you take out food, energy, and shelter prices, the rest of the CPI was negative in March as well, minus 0.7% month over month. So it wasn't just gasoline. We're talking about the kind of broad-based weakness that is a marching band full of red flags, the same red flags that have been put up by the swap market for the last couple years, and really more strongly since last time we went through this marching band full of red flags last summer. The CPI was so negative that not a single one of the 67 forecasters in Bloomberg's survey had predicted a minus for the CPI in March. And in the core CPI, which is close to zero, none of the economists that they surveyed had that one either. What Bloomberg did say was, while the March CPI predates the bulk of the tariff hikes now implemented by the Trump administration, such as the new 125% surtax on Chinese goods, the report offered some encouragement that price gains were stabilizing ahead of the trade moves, and that's absolutely not the case. There was nothing encouraging about the CPI. It was instead more confirmation of the weakness and loss of momentum, again, that the swap market has been saying, fragility in the system, warning about this all along. And just one final note about interest rates. Interest rates are caught between the implications of what was in the CPI report, as well as the swap market and swap spreads, but also the monetary conditions I talked about in yesterday's video. The 2-year U.S. Treasury, which would normally plunge with a CPI like that, confirming both the weakness and the fact the Federal Reserve is not going to be able to stay in the way very long at the short end. Initially, the 2-year Treasury yield fell to 3.82%, but then it moved back to 3.87 before coming down to 3.80 and 3.81. That was after a move higher in rates yesterday. The 10-year has been all over the place. Initially, it dropped from 4.33 to 4.28. Then it moved back up to 4.36, and it's still around 4.36 and 4.37 at the time I started recording this. The Treasury market, which normally would be pricing flight to safety as well as low inflation that's represented and low weak demand that's represented in the CPI report, instead is caught between that flight to safety impulse, but also the monetary difficulties that haven't ended, the liquidations, the disruption in wholesale markets like repo that lead to basis trade selling I talked about yesterday, the deflationary monetary conditions that are likely to cause even greater consequences in the real economy moving forward. So Treasury rates can't fall because they're stuck in this basis trade reserve manager selling loop that keeps the deflationary money pushing the safety yields higher rather than lower. Again, I talked about this in yesterday's video. That's exactly what the swap market has been warning about all of this time, but warning about more strenuously more recently. These negative spreads and the volatility in spreads that preceded them. So CPIs are likely to accelerate from here on the impacts of tariffs, but the one before them, the negative for March, is consistent with everything that we've been saying, we've been seeing, we've been hearing. In fact, it's consistent with the market warnings and the market liquidations. Because what markets are really afraid of is not necessarily the tariffs, it's the loss of momentum in the economy before we even get there. Exactly what the swap market has been warning about, not just the economy, but the fragility in the financial and monetary system that we're seeing all over the place with these liquidations, up to including the basis trade going bad in treasuries, as well as reserve managers who are having to sell because of the deflationary monetary conditions throughout the Eurodollar world, that everything that's consistent with interest rates going down, staying there for a long period of time. So the swap market has been saying all of this time that interest rates were very likely to go a lot lower, to stay there a lot longer, and as spreads got worse and worse and worse, including the volatility in February and March, that the market was increasingly confident the fragility in the economy as well as the monetary system were going to make sure that actually happened. And everything that we're seeing right now, up to including the negative CPI in March, is consistent with these warnings. And as you'll notice, these scenarios that the market is pricing and talking about, these are not good scenarios. Why would Treasury yields rise when they should be going lower during these conditions? Well, that has to do with the basis trade, reserve managers selling, and everything we talked about in the video linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, do take care.